Welcome to Money Matters TV. I'm your host, Mike Dever. I'm founder and Chief Innovation Officer of Brandywine Asset Management. And my guest today is Dave Siegel, Senior Partner of Lighthouse Strategic Advisors. Hello, Dave.
Hi, Mike. Nice to be here.
Yeah, it's great to have you on the show. Now, Dave and I, we go back a number of years now. And when I first talked to Dave, one of the things that just stood out, and it seems like it really defines your character, your personality, is you are a West Point graduate. So what took you to West Point? And then how did you, move from there into wealth management?
Well, it's kind of an interesting path. It was not one that I certainly knew that I was going to find myself on. But in high school, I was number 3 in a family of 4. And my father told me that, we were lower, very lower middle class. In fact, we were just above the poverty level because I knew that there was no money for me to get a scholarship because we made about $500 more a year at that time. This is 1969. And my father made about $12,000 and the poverty line was 10. So I was not eligible for aid. And I knew that I needed to go to college. And so my option was, work through, and I was working as a plumber and sheet metalman in high school. So I could work and go to junior college and go that way. And then something happened to me. I was also a springboard diver at Lodi High School. And I was able to make some pretty good advancements there. And I ended up becoming an All-American diver my junior year. And with that, I got quite a few letters from Ivy League schools, colleges, and being from California, I got, recruited by USC and University of Oregon, Washington, Cornell, SMU, Texas A&M. And I knew that was going to be my ticket. So I worked my butt off to maintain my grades and to maintain my athletic ability. And in the middle of that, I don't know what got me going, but I'd always had an interest in West Point. And I reached out to West Point.
Dave, did you have any family or friends that had gone to West Point?
No, actually, my dad was in the Navy. He was in Korean War and World War II, and he didn't like the Navy. He didn't like the discipline, the marching, the orders, all of the rules that he had to follow. But I had watched a movie when I was 7th, 8th grade called The Long Gray Line, and it was a movie about West Point. And I got really excited because I just saw that these guys were like the best of the best. And my father always taught me, he said, son, I want you to shoot not for the moon, and I want you to shoot for the stars. And if you land on the moon, then you've done okay. He said the problem with most people is they aim for they aim something less than even, they may aim for the mountaintop and they land in the gutter. So aim high. And if you fail, that's okay. And so I had this in my mind that if the best of the best went there, that maybe I should try that also. I had no idea that I could get in. So I applied to West Point and tried to get in. And fortunately, this was right in the middle of Vietnam. I think applications were down a little bit that year. Instead of having, 25,000 applicants to get 1,200 slots, there was probably something like 16,000 applicants to get 1,200 slots. But I made it.
And how much do you think the springboard diving contributed to that?
Well, it was material in that West Point, like all the academies, has a 3-tier rating system. They rank you number 1 on your leadership, like what have you done in your high school to prove that you are, or demonstrate that you're a leader or capable of doing that. That's 33 points. And then they look at your academics and find out whether you're taking hardcore classes and that you're ready to become basically a college graduate at an institution that's academically very challenging. And then they also look at your physical fitness and your athletic ability. And I know that I did really well on my leadership, and I know I did really well on my athletic. I was very athletic. As I come to find out, everybody that went there was very flippin' athletic. Like even the geeky guys that were like super brainiacs were physically fit and could knock out 15 pull-ups and run 2 miles in 12 minutes and in boots. So
yeah, right.
It challenged me. It kind of follows the mantra of if you're a donkey and you strap yourself to a team of donkeys, you look like them and act like them. But if you're a donkey and you strap yourself to a team of thoroughbreds, and you run with the thoroughbreds pretty quick, you start thinking you are one. And I think that was me. I thought I was better than average, but not quite up to what these guys' standards were.
Do you feel you were prepared from high school for just the work ethic and what you needed to do at West Point? And how?
That's a great question. The answer
how was
is
it at West Point?
No. I got my ass whooped really bad. Athletically, I was super fit, and I could do anything and everything that everybody could do. Rope climbs, swimming rivers, building rope bridges, doing all the rifle range, machine guns, hand grenade throw. I was really athletic, and I was able to really excel there. But and leadership wise, I was okay there, and all the guys I were with were just super rock star guys. I think 39% of my class were Eagle Scouts. And so these guys were all really talented and smart. But when I bit into the academic side, holy smokes. I come from California schools, and the California schools today are still pathetic. I took all the algebra, chemistry, trigonometry classes, took the biology, but the standards here are so flippin' low and have remained low. And I went up against the guys from, Massachusetts, New Jersey, New York. I mean, those guys had really solid educations in the sciences, and I didn't. So I had to scramble and really learn to get up to speed. And all 4 years I fought and struggled, because they rank you every single day. And then they post the grades in the Sally ports where you stand, number 1 all the way down to number 1,352. And then they seat you in the classroom according to your academic standing. So you're taking chemistry, and if you're number 252 out of 500 in your regiment, then you set in seat number 252, and that means you're in room 7, seat 4. And so the guy to your left has got a better grade than you, and the guy to your right is not.
There's no hiding.
No, very competitive. And there was 15 to 17 cadets in every classroom with a professor. So there was no hiding.
And was that preparation? Now you ended up in the Army. How long did you serve? Under what, what areas? And did you feel then you were prepared when you graduated?
I felt West Point did an unbelievable good job. A lot of West Point was very painful, and you operated your day as a freshman like, how am I going to get through the next 10 minutes? As a sophomore, you operated your day as, how am I going to get through the day? Because the academic load was so heavy. Everybody was taking, sophomores, 22 units plus full military, plus full intercollegiate sports, and plus extra clubs that you had to be participating in at least 1 or 2 clubs every semester. So the load was just so heavy, and they wanted to do that because they wanted you to figure out how to survive under great pressure and not be stressed out about it. So but I felt the military. I graduated in '74. I did not go to Vietnam. I prepared. I thought I was going to Vietnam. I thought I was going to be in the Mekong Delta, and I wanted to be the best troop leader. So I selected infantry, and I wanted to be an Army Ranger. And so I went to airborne school and Ranger school and got commissioned and got put overseas to Europe, where I wanted to go along and sit across the border from the Russians. I mean, I was looking for a fight. If we're going to fight, I wanted to be in it.
Yeah.
And so we trained and worked. And then one of the fun jobs I got, they made me a nuclear demolitions officer. So I got to handle small 1 kiloton nukes that we pre-chambered in the roads. And there was, I think, 14 Russian divisions across the border from us with our 1 division. And we had to basically delay for about a 2-week period so the United States could, answer
resupply
and bring over the military. We had about 3 divisions in all of Europe, and I think we still have 2 divisions over there now.
Yeah. So how long were you in the military, and what caused the transition from there into what you ended up doing?
So I stayed in I stayed in 6.5 years, and I went to the Armored Officers Advanced Course as an infantry officer. I'd done so well with my reporting and my efficiency reports that they wanted to cross-train me. and I enjoyed that. So I had one more year of obligation. Every schooling you go to, or every advancement you go to, there's another year or two of obligation. So I got out after I finished my obligation, and I got out after the Berlin Wall came down, and it looked to me like there was going to be not as much opportunity in the military going forward. That looked like we had peace, and I never foresaw Iraq and Afghanistan and Balkan Islands, and I never saw anything.
Iraq was within 2 years after the wall falling. I mean, it was really quickly that took place, and that kind of haunted us for a couple decades. You know, and
so I got out as a captain, and I just wanted to get paid and promoted commensurate with my skills and abilities. And I didn't care what career I was in, as long as I enjoyed whatever it was. It had to be ethical and honorable, and it had to be positive for mankind. And it needed to pay me for all the work I did. I was tired of working as a captain. In my last job, I was doing a lieutenant colonel's job as the brigade adjutant, and I was a captain, and I received a Meritorious Service Cross for that, which was a very, very high, peaceful honor. And I could have been doing that job 8 or 10 years down the line and repeated. So one of the things I looked at medical device sales, engineering, interviewed with 32 Fortune 500 companies. And then I found this one opportunity. I ran into a fellow who was a Navy commander, and he said his friend took a job with this company and said he said if he'd have known this job was available, it had changed his life. It was his third career. And I went and talked to him, a guy named Ted Lynott, and he told me about the securities industry. And it was exciting because, like, if you didn't get anything, you didn't get paid anything. And if you did something, you got paid, and you could help people at the same time. And I started in the industry as a municipal bond broker, cold calling, selling people tax-free bonds. And from there, I turned into a full service financial advisor, and was a branch manager for 18 years, hiring and training people how to do the business. And then I got to a point where they bought Pacific Life bought our company, and I was a senior executive at the company, and I decided, do I want to go be a manager for them, or am I better off just going into business myself? And I think the one thing that I love best about this business is working with individual people that had unique financial problems, and you could help them solve those problems by correctly identifying what the problem is and what's the best, most optimal, tax efficient solution to get to the land of financial independence. Because then and only then you can start to worry about what's really important in life. And that's not money. It's your family, it's your faith, it's your friends. Life is about the memories you make, the people that you love, and the times that you spend together. And money is just a tool. So I wanted to make sure that I had enough money, and I love helping clients make sure they have enough money, and they don't need to worry about their money because I'm on their team. We screw up, we're going to come live with you, Siegel. Had a client come live with me.
So what's that look like today? How has the firm grown? What's your philosophy? What kind of clients are you serving?
Well, I'm in a great spot. I'm in my middle 70s, and I love what I do. I have no desire to retire. I have plenty of time off. I make plenty of money. And if you love what you do, you should never stop doing it, because it keeps me young. It keeps me going to the gym, working out. I hunt, I fish. I'm quite active. I have a wonderful wife. Been married 50 years to this woman. We're going to go to Tahiti on our 50th anniversary because it's been on her bucket list forever. And I have
congratulations. That's great.
You. It's, if you pick the right woman, man, your life can be so much better than if you pick the wrong one. As a matter of fact, I always counsel the young people, the single most important financial decision. And they're looking like, what stock do you buy? No, who you marry. If you marry a good woman, she will make you be better.
It's that way.
The wrong person, and you'll be worse, and you'll have only half the money.
You know what? I mean, obviously, the marriage is utmost important because that's a person you are spending so much time, the rest of your life, sharing so much with. But that decision holds true in every interaction and every person you deal with. through your life, whether it's a business partner or a
So true.
client, whatever it is, you want is all those relationships need to be compatible, comfortable and enjoyable. Otherwise, what's the sense of doing it?
Yeah. If you've got your person or not. And if you don't, man, it's tough, especially if you have kids in the picture. So I've just seen so many people that have a broken picker, and they keep picking the wrong people. And like, that's, what you think you want is not what you need. So it's tough. But as a financial advisor, I've seen the destruction that happens when you don't have the right partner. And I've seen the beauty and the magnificence and the fulfillment of when you do have the right partner. Because life's gonna challenge you. It's gonna kick your butt. You don't get out of here. Nobody is getting out of here alive. So you do need to make sure that you're a fighter and you're a scrapper, and that you've got resources and abilities and tools to overcome these challenges. And having a partner along with you is a really good start. Gives you a huge advantage over trying to do it solo.
Absolutely. No, it's being a lone wolf is very, very difficult. And you're running your firm. You're making a lot of decisions day to day, and it's good to have somebody that has your back on anything outside of that. For
Yes.
sure. On the running the firm side, do you have like model portfolios you create for clients, or are you customizing for each client? Does it matter what your viewpoint is on the economy? Do you skew things based on that, or what's your philosophy as far as putting portfolios together and managing clients' assets?
That's a great question. I've had a chance over my lifetime. I've probably seen just about every way that you possibly can manage money. And even when I was at West Point, I bought an 8% stake in a concrete and pipe company that had really good real estate, and we bought it really, really cheap. And I ended up making a lot of money on that while I was at West Point. And I used one of my professors there to help me structure the contract and make the purchase, and that kind of got me going. But I've learned that doing individuals situations like buying an individual stock, you have to have a leg up. It's like if you think you can go play golf and beat Tiger Woods and Rory McIlroy and some of these people, that's the same odds you have in Wall Street. So unless you've got something unique about yourself, or your expertise, or your advisor has something unique about it, then you're best having about 80% of your assets in exchange traded funds, or actively managed ETFs, or passively managed index funds at low cost, and build a portfolio under modern portfolio theory that's going to get you there long term through good markets and bad markets. And in that respect, I kind of have the Warren Buffett approach, but he used individual stocks. And I have found that for the average person, usually ETFs are the first choice because they're the most economical. Some actively managed mutual funds are maybe a second choice. And more recently, I do like actively managed ETFs that follow an index or a strategy, so I'm not stuck with crappy stocks in the portfolio. One of the things that most people don't understand is, let's say the S&P 500 over the last 50 years has returned about 10%. That if you look at what stocks in the S&P 500, what was the mean return, you would think that, well, 50% of the stocks, or 250, would perform less than the S&P average, and 250 would perform more than the S&P 500 average. That's how you get the average, right? Well, that's not the case, because you look at the facts and you see that 76% of all stocks in the S&P 500 over the last 50 years fail to achieve the S&P 500 index return.
Mm-hmm. And you've got the few outliers.
It is the outliers. It is the overperformers. It's the alpha dogs that do phenomenally well. It's like right now, it's the Magnificent Seven. It's carried the S&P 500 the last 2.5, 3 years. Without those, the S&P 500 would be a 3-4% return. With them, it's 18 to 20.
Well, so that brings up a question, Dave. So it's actually our viewer question, because it gets down to the issue of whether or not these Mag 7 have grown too much, whether the market on average is overvalued. And so this is a question that, if you could help us answer this, from Martin Thomas in Boston. Do you think the stock market is overvalued at this time? And if so, what will cause it to get better or worse?
Mr. Thomas, that's a great question. If there's one question that you would want to ask, that's the one you would want to ask. And the answer, I'm going to try to give you my opinion on it. But it's reflective of all of the research that we follow, and we try to get as much independent, non-Wall Street research as possible when we try to arrive at a solution to a problem. I would say that the first thing that you would look at would be the CAPE ratio. And the CAPE ratio is just the average PE of all the stocks smoothed out. And it's one of the symbols that Warren Buffett likes to use more than anything. And the CAPE ratio will have you almost nauseous. It looks like Mount Kilimanjaro. I think in 1928.
The CAPE stands for cyclically adjusted PE.
Yes.
So a lot of people look at the price earnings ratio. They might look at it as the current, or usually viewing the 1 year out earnings in the E side of PE.
Yes.
And the CAPE is smoothing it over 10 years of earnings. So it's trying to take out the cycles that have occurred. And right, what Dave, you're pointing out is we're at levels in the CAPE that we haven't seen since really when the dot-com bust occurred in 2000.
It's the dot-com bust in 98, 99, 2000, and then it's the 28, 29 market, prior to the market crash. So the CAPE ratio is just underneath those right now. So on a PE basis, it's very expensive. And now you say, well, how did it get that way? Well, it's that way because people are willing to pay more for these companies, especially the Magnificent Seven, that are growing at rates of 20, 30, 40% earnings growth per year on a consistent basis. And then you have companies like NVIDIA that are even blowing that away, or Palantir. So I would say that the market is very expensive, and it's probably going to get more expensive before it gets cheaper. That doesn't mean that we don't have some corrections. We already had a nice little pullback in February, but it turned right around and rallied right back up by the end of March. So the truth is, the future is unknowable, and I really don't know. And therefore, the type of portfolio that you want to pursue and the strategy is the most important thing, because nobody ever knows the future.
Mm-hmm.
And you cannot make money in this market by trying to be a predictor of the future, because it's not knowable. You can get lucky, you can get this and that, and that's great. And so strategically, you can add to the portfolio, maybe that last 20%. Like, I've been a big believer in gold, silver, and rare earths for about 3 years. And so we loaded up on those with a 10% position. And now it represents almost 20% of everyone's portfolio. And I still think it's got room to run. So we're holding on to that. But I think the rest of the portfolio, you want to use a portfolio that's got large, mid, and small growth stocks in there, and value stocks. And you want to have mid and small cap value. You want to have an international exposure. Get out of you can't just stay in the US, and try not to hit home runs. Try to hit singles and doubles every year. And that's going to get you to the land of milk and honey. You know, the Fidelity has run several different reports, and they have their average mutual fund over a 10-year period turned in about a 9% return. That's their average mutual fund. And what they found out is that their average client at Fidelity during that same period of time was only making about 3.5%. And that's because people get emotionally involved. And when things get to be horribly scary, you need to be looking at being a buyer, not a seller. But when you've had a $200,000 portfolio, which is, say, your entire retirement portfolio, your entire stock portfolio, it's now down to 100,000. You say, I can't handle the pain anymore. I got to get out.
Yeah,
and then this is back up, and then you end up buying back in high again, and you chase it. So
this was something I did write about in my book, Jackass Investing, which was the #1 mutual fund bestseller on the Kindle in 2011.
Hey, there you go.
Very good. Thank you.
It's a great book.
Yeah, and thank you very much. The early chapters of that, I talk about the dollar studies that show that people underperform the very funds into which they invest by as much as 5% a year. And that's just a consistent rolling 20-year window of underperformance. And it's because people are buying the funds at the top when they're hot, and they're selling out and, getting rid of them when they're down, and they panic out of that. I did have one little break here we're going to take, Dave. This is for people who want to send in questions. We had a long answer on this question about the overvaluation and the market, but if you'd like to send in your question to Money Matters TV, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Okay, so Dave, we only have about 3 minutes left, and we've touched on a number of topics here, but the one that I think is most relevant is what we just left off with, and that is the emotions of investing. And I would think that your job, your responsibility, is to keep the investors focused on what it is they're doing, what you have planned for them, and to keep them level-headed when maybe that's not working as exactly as it's supposed to be. Would you agree with that?
Absolutely. And we set that up ahead of time. So it's almost like hitting big ruts, driving your car down a rough road. You don't know when the ruts are going, so don't drive faster than what you can handle a big rut in case you hit it. So the market, it's going to have burps and hiccups and along the way, 10, 15, 20% train wrecks along the way. So you don't have all your money in that bucket that gets wrecked and scares you. So you have a certain amount of money in low intermediate risk, some in moderate risk, and then some at high risk. And typically the money that you don't need for at least 10 years, that's your high risk bucket. And so when it does happen, my clients don't even call me anymore. In fact, if you call me during the middle of a market crash and I haven't called you, the very first thing I'm going to say is, so nice that you called. You must have some cash. Send it to me. We're buying today.
Uh-huh.
So if they don't want to buy more because they're scared, they don't want to call me. So you set this up ahead of time. So like in the market crashes, even in the Trump tariff
tantrum
that hit. I think I had one client call me and he just said, just checking in and see if there's anything I should be buying today. So you set these things up ahead of time so you're prepared to get there no matter what. Fidelity found out that the people that got closest to their average return of like 9% on their mutual funds were people that forgot they had money at Fidelity.
Enjoyed our time, Dave. Thanks for sharing it with us on the show.
Nice. Thanks. Nice talking to you too, Mike.
Yes, you're welcome. Our next guest on Money Matters TV is Tom McManamum, CEO of Stimulus Brand. Until then, thank you for watching Money Matters TV, where your money matters. We'll see you next time.